What if I told you that it currently costs just as much to put a solar panel on an 18-wheeler in Ohio and drive it to California as it does to load that exact same panel onto a massive cargo ship in Asia and sail it across the entire Pacific Ocean?
I mean, it completely shatters the fundamental assumption most of us have, right? Like about localized manufacturing.
Yeah, totally.
We just naturally assume that building things closer to home automatically saves money on shipping and logistics. But the reality of the current industrial landscape is, well, it's just far more complicated than that.
It really is. And yet here we are in the second quarter of 2026, looking at a manufacturing landscape where the basic laws of logistics just seem to have been turned entirely upside down.
Completely upside down.
So welcome to the Deep Dive. Today we are putting on our investor hats to bring you a highly concentrated, heavily data-forward breakdown of First Solar's Q2 earnings call.
Right, looking at the ticker symbol FSLR.
Exactly. And our mission for you today is to basically filter out the corporate noise. Because, let's be real, earnings calls are notorious for just burying the lead under layers of Wall Street jargon and executive preamble.
Oh yeah, they love a good preamble.
They really do. So we are going to translate that jargon into plain English, unpack the underlying mechanics of their business, and deliver a concise, actionable analysis of what is actually happening under the hood of this company.
Because on the surface, I mean, First Solar just surpassed a massive, almost incomprehensible milestone.
Yeah, this was huge.
They have officially shipped 100 gigawatts of cumulative module sales globally over the last 2.5 decades.
And let's actually visualize that for a second, because a gigawatt is one of those terms that gets thrown around so much, it kind of loses its meaning, you know?
Right. It just sounds like a sci-fi word.
Exactly, Back to the Future. But 1 gigawatt is roughly the equivalent of a mid-sized nuclear reactor. So 100 gigawatts, you were talking about the theoretical capacity to replace 100 nuclear power plants.
Which is staggering.
To put that in consumer terms, 100 gigawatts is enough to power tens of millions of average households. If you were to lay those panels out side by side, you are talking about covering entire metropolitan areas in glass and semiconductors.
It really speaks to the incredible durability of their specific thin film technology, and just the sheer scale of their manufacturing platform.
Yeah.
I mean, to survive 25 years in solar manufacturing, which is an industry known for just vicious boom and bust cycles and, frankly, ruthless foreign competition, that is an anomaly in itself.
Oh, absolutely. But as any seasoned investor knows, past performance doesn't pay today's dividends. The market is always forward-looking.
Right.
So the pressing question for you listening right now is, what does their immediate financial health look like today, right now in the second quarter of 2026?
So let's get right into the headline numbers.
Let's do it.
Because if you just read the top line of the press release, you might actually get a little spooked. Net sales for Q2 came in at $1.06 billion.
And on its face, that is actually a 4% decrease year over year.
Right. And if you're holding this stock, seeing revenue shrink during what is, universally acknowledged as a massive global renewable energy boom that feels like a glaring red flag.
Oh, big time. It absolutely looks like a red flag on a superficial scan.
Yeah.
But this is exactly why we do these deep dives. You cannot let that top line revenue dip fool you.
No, you can't. If you dig into the supplementary financial data provided in the call, that 4% drop was not due to a lack of demand. Not at all.
Right.
It was primarily driven by lower revenue from customer contract terminations that had artificially spiked the top line in the previous year's quarter.
Okay, I want to pause and just unpack the mechanics of that, because contract terminations sounds inherently negative, right?
It does, yeah.
Why would a customer canceling an order actually result in a revenue spike for First Solar? And why is a decrease in those cancellations a good thing now? Okay,
so to understand this, you really have to understand the anatomy of a utility-scale solar deal. When a major project developer decides to build, say, a 500 megawatts solar farm, they're dealing with a development cycle that can take 3 to 5 years.
Easily.
Right. They have to secure land rights, get environmental permits, lock in financing, and most importantly, get approval to connect to the regional power grid.
Which is known as the interconnection queue, right?
Exactly, the interconnection queue. And over a 3 to 5 year period, a lot of things can go wrong.
Yeah, markets change, politicians change.
Let's say a developer signs a massive contract with First Solar to buy $200 million worth of panels. They put down these hefty deposits, but 2 years later, maybe the local county commissioner blocks their land use permit.
Or, interest rates spike so high that their bank just pulls the project financing entirely.
Yes, perfect example. So the developer is forced to abandon the project. When they terminate that contract with First Solar doesn't just, give the money back.
Right, they aren't a charity.
No. According to the terms of these massive industrial agreements, First Solar retains a substantial cancellation fee, or they're allowed to recognize a portion of the revenue immediately without ever having to physically ship the panels.
Wow. So last year, First Solar experienced a wave of these project cancellations. They kept the termination fees, which artificially inflated their Q2 revenue last year.
Exactly. But this year, the development pipeline is healthier. Fewer projects are falling apart, meaning fewer termination fees.
Which means that ironclad long-term revenue is being realized through actual product delivery rather than just, penalties.
Right. So ironically, the lower revenue figure this quarter is actually an indicator of a much more stable, predictable delivery pipeline.
That makes so much sense. And that stability becomes incredibly obvious when you look at the next line down on the income statement, which is net income.
Oh yeah, they're flashing bright green here.
Bright green. Net income came in at $423 million, which is up a staggering 24% year over year. So revenue is slightly down because they aren't collecting as many penalty fees, but actual core profit is up by almost a quarter.
Yeah. And if we look at their operational efficiency, the metric you really want to focus on is adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Right.
This metric basically strips out the accounting variables and shows you the raw cash-generating power of their core operations.
Yeah.
And for Q2, adjusted EBITDA just crushed expectations, coming in at $644 million.
Which beat the absolute highest end of their own internal Q2 preview range.
It did, but okay, here is where I want to push back and bring up a massive discrepancy from the actual earnings call transcript.
Oh, I know exactly what you're going to say.
Right, because I was reading through the preamble, and early in the call, Mark, the CEO, is giving his opening remarks. And he mentions expanding gross margins to, quote, approximately 90%.
Yeah, I read that and my jaw hit the floor.
I mean, in hardware manufacturing, a 90% gross margin is virtually impossible. That is the kind of margin you see in software companies like Microsoft or Adobe, where the cost of replicating a digital product is literally zero.
Exactly. Building physical glass and steel solar panels with a 90% margin defies the laws of physics and economics.
But then 20 minutes later on the call, Alex, the CFO, comes on and clarifies that gross margin was actually about 57%.
So what is going on there? Is the CEO just throwing out wild numbers?
Well, it's a phenomenal catch, and it really highlights the psychological theater of earnings calls.
The theater, yes.
When a CEO throws out a headline-grabbing number like 90%, they're often cherry-picking a highly specific, localized product line. Or they're referring to some adjusted metric that excludes major fixed costs, simply to paint the most optimistic picture possible during their, unscripted or loosely scripted remarks.
But that's incredibly dangerous for a retail investor who just listens to the first 5 minutes of the call and assumes the company is magically printing money at software margins.
It is dangerous. It really is. That is why, for you, the investor, the 57% figure provided by the CFO is the only reliable metric. That 57% is grounded in GAAP.
Okay, let's define GAAP quickly for anyone who doesn't spend their weekends reading accounting textbooks.
Please do.
So GAAP stands for Generally Accepted Accounting Principles. It's the standardized set of rules that all publicly traded companies in the U.S. have to follow. It ensures that when you look at First Solar's gross margin, you're comparing apples to apples with any other manufacturing company.
Right.
It prevents companies from legally hiding costs to make their profits look better than they actually are.
Spot on. And while 57% isn't 90%, we had to acknowledge that a 57% GAAP gross margin in heavy physical manufacturing is still absolutely phenomenal.
Oh, it's incredible.
It represents an increase of 12 full percentage points year over year. But again, we have to ask why. A 12-point jump in gross margin for an industrial manufacturer doesn't happen just because the assembly line workers drink more coffee.
No, it doesn't.
You have to look at the external levers.
And the transcript spells those levers out very clearly. That massive margin boost was heavily driven by two specific things. First, an $89 million net IEPA tariff-related benefit. And crucially, a significantly higher mix of their modules qualifying for Section 45X tax credits.
Okay, let's break down the Section 45X tax credit because this is the beating heart of First Solar's current profitability.
It really is.
Section 45X is a provision within the Inflation Reduction Act. And the goal of this legislation was to rapidly build up domestic supply chain resilience in the United States, specifically for green energy.
Right, because for decades, the U.S. basically surrendered solar manufacturing to Asia.
Exactly. Section 45X is the U.S. government's attempt to buy that industry back.
And it is not just a standard tax deduction where they write off some expenses, right?
Well, not at all.
Section 45X is an advanced manufacturing production credit. It is a direct per-watt subsidy paid by the federal government for every single component manufactured inside the United States.
Precisely. If you are importing panels from overseas, you get nothing. But because First Solar operates massive foundries in Ohio, they are receiving lucrative, direct financial incentives for every square foot of glass and semiconductor they produce domestically.
It fundamentally alters their unit economics.
It does. The government is essentially paying them a premium to ensure the U.S. electrical grid isn't solely reliant on foreign adversaries for its physical infrastructure.
Okay, so we have a situation where the bottom line numbers are looking stellar. They have a 57% margin, a massive EBITDA beat, and the U.S. taxpayer is heavily subsidizing their unit economics.
Yep.
But a subsidized margin only matters if someone actually wants to buy the product.
Exactly. Which
Which brings us to the real-world demand driving this company.
And if you want to understand the future of First Solar, you have to look at their backlog.
The numbers here are genuinely staggering. First Solar is currently sitting on a 45.1 gigawatt contracted backlog.
Right. And to be clear, this isn't theoretical demand. These are signed contracts stretching all the way through the year 2030.
Let's attach a firm dollar figure to that physical capacity, because the aggregate transaction value of that 45.1 gigawatt backlog is $13.6 billion.
Wow.
That is $13.6 billion of locked-in, contracted future revenue sitting on their books.
And they are not resting on their laurels either. The earnings call noted that just since their last quarterly update, they booked another 1.9 gigawatts of new orders in the U.S.
At an average selling price, or ASP, of 36 cents per watt.
I really want to contextualize that 36 cents per watt figure because it tells a massive story about the global trade environment right now.
Yeah, please do.
Right now in the global spot market, Chinese manufactured solar panels are frequently being dumped at prices well below 15 cents, sometimes even sub 10 cents per watt.
Which is crazy. So First Solar is successfully selling their product for double, sometimes triple the cost of their foreign competitor.
Yes.
Why on earth would a U.S. developer pay 36 cents a watt when they could theoretically buy cheap imported panels for a fraction of the cost?
Certainty.
Just certainty.
Certainty. U.S. buyers are paying a massive premium for absolute certainty. If you are building a billion-dollar solar farm, you cannot afford for your panels to be seized at U.S. Customs because they violate, the Eiger Forced Labor Prevention Act.
Right, that would be a disaster.
You cannot afford for retroactive tariffs to suddenly add a 200% tax to your imported panels while they are literally sitting on a cargo ship in the middle of the ocean.
Oh, man, yeah.
First Solar provides a politically safe, domestically manufactured product that is guaranteed to arrive on time and comply with all U.S. trade laws.
Okay, that makes perfect sense. But let's dig into the actual source of this demand. Because for the last 20 years, solar demand was largely driven by government ESG mandates or traditional utility companies slowly retiring coal plants and, trying to hit green energy targets.
Right, the traditional drivers.
But there is a new player in the energy market, and they are entirely reshaping the physical footprint of the electrical grid.
They really are. If we want to understand the modern utility scale solar market, we have to talk about the artificial intelligence boom.
Yes.
The underlying driver for this $13.6 billion backlog isn't just standard population growth. It is the exploding load growth from hyperscale data centers.
This was honestly the most fascinating part of the earnings call for me. Management highlighted a highly specific project that perfectly illustrates this macro trend.
The Steel River one.
Yes, the Cypress Creek Steel River project located in Arkansas. This project consists of an initial phase of 1.6 gigawatts of solar generation.
Right.
But here's the kicker. It is paired with 1.9 gigawatt hours of battery storage. And this entire massive infrastructure project is being built specifically to support the energy needs of Google.
Let's just unpack the sheer scale of that battery storage, because a 1.9 gigawatt hour battery is an architectural marvel.
It's massive.
We aren't talking about a few batteries in a basement here. We are talking about hundreds of shipping containers packed with lithium-ion cells requiring their own massive thermal management and fire suppression systems.
And why does Google need a battery that big?
Because of the fundamental physics of an AI data center.
Okay.
When you train a large language model, or process millions of AI inference queries, the GPUs inside those data centers draw a colossal, continuous amount of electricity. A Google data center does not get to go to sleep when the sun goes down.
No, it doesn't.
They require 247 uninterrupted baseload power.
And solar power, by its very nature, is intermittent.
Right.
A cloud rolls over, production drops.
Exactly.
The sun sets, production goes to zero. Yeah. And if you are running an AI model, a sudden voltage drop will literally crash the servers.
It will. Intermittent solar alone cannot solve the hyperscaler problem. You have to pair massive solar arrays with even more massive battery installations to capture the midday solar peak, store it, and smoothly discharge it throughout the night to keep those servers humming.
You think of it this way. Imagine the AI data center as a high-performance Le Mans endurance sports car. It has to run at top speed for 24 hours a day without stopping.
I like that analogy.
Right. The AI software is the engine. The NVIDIA chips are the transmission. But none of it matters without an absolute torrent of high-octane fuel.
Right.
First Solar and these massive battery systems are the specialized fuel infrastructure. First, Solar isn't trying to build the next ChatGPT. They aren't designing the silicon chips.
Oh.
They are providing the essential, unglamorous physical foundation required to keep this technological revolution from literally going dark.
It is a vital distinction to make. And the executives on the call explicitly reference this, noting the insatiable demand from hyperscalers.
Insatiable.
We are talking about companies with multi-trillion-dollar market caps, Google, Microsoft, Amazon, and they are caught in a paradox right now.
Oh, so?
On one hand, they have made incredibly aggressive public pledges to become net zero carbon emitters.
Right, the ESG goals.
On the other hand, they are engaging in an AI arms race that requires an exponential increase in electricity consumption.
They can't exactly power these new AI data centers with coal without destroying their public ESG pledges.
Exactly. So First Solar provides the only domestic, politically safe, utility-scale solution that allows them to scale AI while remaining carbon neutral.
And crucially, these hyperscalers are entirely price insensitive.
Oh, completely.
A company like Google, sitting on billions in cash, does not care if a solar panel costs 15 cents or 36 cents. They only care about securing guaranteed, reliable energy capacity on a highly specific timeline.
That's all that matters to them. Reliability and speed.
Okay, so let's synthesize what we have so far. First, Solar has a $13.6 billion backlog. They are printing cash with a 57% gross margin. The U.S. government is subsidizing their manufacturing through the IRA, and the most powerful tech companies in the history of the world are lining up to buy their product at a massive premium to power the AI revolution.
That's pretty good, right?
Right. If you stop reading the transcript right there, it sounds like financial utopia. So I have to ask the obvious question, what is the catch? Like, why isn't the stock trading at $1 trillion?
Because operating a physical manufacturing business in 2026 comes with immense friction.
Real-world friction.
Exactly. The primary headwind they are facing right now is found in the supply chain and domestic input costs.
And this brings us back to the hook we started the show with. The earnings call transcript got surprisingly granular about flight logistics, and the statistics they shared were genuinely shocking to me.
Yeah, it was wild to hear them spill it out like that.
The executives noted that due to severe capacity tightening in the domestic trucking market and wild volatility in diesel fuel costs, it currently costs almost as much to truck a shipment of solar panels from their factory in Perrysburg, Ohio, across the country to the U.S. West Coast, as it does to load those same panels onto a ship in Asia and sail them across the entire ocean.
We just have to let the absurdity of that reality sink in for a minute.
It's nuts.
The cost of domestic overland trucking, literally simply crossing a few time zones on the interstate highway system, is approaching the economic cost of trans-Pacific maritime shipping.
Take me through the mechanics of why that is happening. Like, why is it so outrageously expensive to put something on a truck right now?
Well, it is a confluence of multiple macroeconomic factors. First, you have a severe chronic shortage of long-haul truck drivers in the United States.
Right.
The workforce is aging out rapidly, and younger generations are just not entering the profession at the replacement rate.
It's a tough job.
It is. Second, you have the wild volatility of diesel prices, which obviously directly impact freight rates.
And we also have to consider the physical nature of the product itself, right? Because a First Solar panel isn't a box of feather pillows.
Definitely not.
These modules are essentially two thick sheets of highly durable glass with a microscopic layer of semiconductor material sandwiched between them. They are incredibly heavy. You can only fit so many on a single flatbed before you literally hit highway weight limit.
Exactly. When you factor in the weight, the fragility, which requires highly specialized packing, the insurance costs, and the driver shortage, the logistical advantage of localized manufacturing starts to erode pretty quickly.
It really does.
You build a state-of-the-art factory in Ohio to be closer to your American customer and bypass international shipping chaos.
Right.
But then the realities of the domestic interstate system eat up a massive chunk of your profit margin anyway.
And it isn't just freight. Management explicitly noted rising domestic input costs across the board. The reindustrialization of the United States, the whole Made in America push means that everyone is trying to build new factories and infrastructure at the exact same time.
Which creates massive upward pressure on raw commodities.
Yeah.
Everyone is competing for the same steel, the same copper, the same concrete, and the exact same specialized construction labor.
Now, I know First Solar has a bit of a technological advantage here because they use a proprietary thin film technology, cadmium telluride. They don't require vast amounts of highly refined polysilicon or expensive silver paste like their Chinese competitors do.
Sure.
But they still need massive amounts of architectural glass, aluminum for the panel frames, and enormous amounts of raw electricity just to run the foundries.
That is correct. As the CEO frankly noted on the call, it is a profoundly challenging environment for wringing costs out of the manufacturing process right now.
Yeah.
Inflation is stubborn, and building physical goods in America is just fundamentally expensive.
So we have this really fascinating dynamic. The top line demand from the AI boom is stellar, but the bottom line execution is turning into a daily, grinding street fight with domestic inflation and logistical bottlenecks.
That's a great way to put it.
How management navigates these opposing forces is critical, which transitions us perfectly into our analysis of management guidance.
Let's do it.
Because steering a multi-billion-dollar company through these crosswinds requires some very calculated and sometimes, controversial strategic maneuvering.
Let's start with their immediate projections. For the third quarter, management expects the volume of panels sold to be between 3.9 and 4.5 gigawatts, yielding an adjusted EBITDA hovering between $625 million and $775 million.
That feels like a very solid, steady continuation of their current operational rhythm.
It is. It shows they are maintaining their stride despite the freight costs. But the truly interesting strategic move revealed on this call has to do with their long-term capital expenditures, specifically the rollout of their brand new manufacturing facility in South Carolina.
Okay, let's unpack this, because this decision raised a lot of eyebrows on Wall Street.
Oh, definitely.
The South Carolina facility is a massive part of their growth narrative. Management confirmed that phase 1 of the factory is on track to begin commercial operations in the second half of 2026. However, they abruptly announced that phase 2, the expansion of that factory, is being intentionally delayed until mid-2027.
Right.
I want to challenge the logic here for a second.
Go for it.
If you have an insatiable demand from tech giants, a $13 billion backlog, and customers literally lining up to pay a premium for your product, why on earth would you intentionally delay the opening of new manufacturing capacity?
On a short-term, quarter-to-quarter basis, it looks like a mistake.
It looks like you're leaving money on the table.
Exactly.
Yeah.
But this is where we see the distinct difference between short-term quarterly appeasement and long-term margin protection.
Okay.
Management is delaying the physical rollout of phase 2 so that they can fully incorporate their brand new CuRe technology directly into the manufacturing line closer to the factory's launch.
Okay, I have read a little bit about this CuRe technology, but take me through the actual mechanics of it. What does it stand for? How does it work? And why is it worth delaying a multi-million-dollar factory expansion?
Let's get into the physics for a moment.
Right.
As we mentioned, First Solar does not use traditional silicon. They use a thin film technology called cadmium telluride, or CDT.
Right.
Historically, to make these panels conductive and efficient, manufacturers would dope the semiconductor material with copper.
Right, because copper is highly conductive.
It is.
Yeah.
But it has a fatal flaw over a long time horizon. Over 20 or 30 years of sitting in the baking sun, those copper atoms tend to migrate and diffuse throughout the panel.
Huh.
Yeah. And this migration causes the panel to slowly degrade, losing its energy efficiency over time.
I see.
So, CuRe stands for copper replacement. First, Solar's engineers have developed a proprietary way to replace the copper with a different, highly stable element that does not migrate under thermal stress.
So by eliminating the copper, you eliminate the degradation.
Precisely. The panel maintains a higher efficiency over a much longer lifespan. It allows them to squeeze significantly more watts of energy generation out of the exact same physical footprint of glass and aluminum.
And in the utility scale solar business, efficiency is the holy grail.
It really is.
If you can increase the wattage output of a single panel without increasing the raw materials used to make it, you fundamentally lower the manufacturing cost per watt.
Yep.
Furthermore, because the panel generates more total electricity over its lifetime, the developer's levelized cost of energy, the LCOE, plummets.
Exactly.
And that allows First Solar to justify an even higher average selling price to the customer.
Exactly. So delaying the factory is a highly calculated mathematical gamble. They are willingly sacrificing a few months of revenue from older, less efficient technology to ensure that when phase 2 finally spins up, it is printing modules with vastly superior unit economics.
And significantly higher margins for the next decade.
Exactly.
That's a great strategy. Imagine Apple delaying the release of the next iPhone by 6 months just to ensure they can incorporate a revolutionary new microchip that is twice as fast and uses half the battery.
Right.
They lose out on immediate holiday sales, but they guarantee that they can charge a massive premium for the device over the next 3 years while completely outclassing their competitors. It shows remarkable discipline from First Solar's management.
It is a textbook example of long-term strategic discipline.
But you know, the flip side of that is a strategy that seems, quite frankly, a little reckless.
Oh,
yeah. I want to pivot and talk about the elephant in the room regarding their international operations.
Yes. Southeast Asia.
Right. We've spent this entire time talking about their American factories in Ohio and South Carolina. But First Solar also owns massive, sprawling manufacturing facilities in Malaysia and Vietnam.
Very true.
And according to this earnings transcript, they are intentionally running those massive Southeast Asian factories at a fraction of their capacity. The CFO noted they are absorbing roughly $30 million a quarter in underutilization costs.
Which hurts.
They are essentially lighting $30 million on fire every 3 months just to keep the lights on and the machines idling. How can that possibly be a sound business decision?
When you look at the raw accounting, eating a $30 million quarterly loss is painful. There's no getting around that.
Yeah.
But what is truly fascinating here is the high-stakes geopolitical chess game that management is playing with Washington, D.C.
Okay, unpack that for me.
They are treating these multi-hundred-million-dollar physical factories in Southeast Asia exactly like a financial options contract.
Okay, let me break down the concept of an options contract for a moment, because applying it to physical real estate is brilliant.
It really is.
In the financial markets, an options contract gives you the right, but not the obligation, to buy or sell an asset at a specific price at some point in the future. You pay an upfront premium for that right.
Right.
If the market moves in your favor, you exercise the option, leverage your position, and make a fortune. If the market moves against you, you simply do nothing, and your only loss is the premium you paid.
Now, map that exact financial framework onto a physical supply chain. First Solar is paying a $30 million premium every single quarter to maintain the option to flood the market with panels. But they are refusing to exercise that option until the U.S. government makes a final, definitive policy decision regarding something known as Section 232.
Okay, we need to dive into the weeds of international trade law to understand this. What exactly is Section 232, and why is First Solar holding their breath over it?
Section 232 is a piece of U.S. trade law that grants the federal government the authority to impose sweeping tariffs or strict quotas on foreign imports if it is determined that those imports pose a threat to U.S. national security.
Yes.
And currently, there is a massive, highly politicized investigation into the tidal wave of cheap polysilicon and solar components flooding the global market.
Great. From China.
Yes. These components are heavily backed by Chinese state capital, and while they might be assembled in places like Vietnam or Malaysia to obscure their origin, the economic engine driving them is Chinese overcapacity.
Now, I want to be very clear here for our listeners. We are not taking a political stance on whether tariffs are inherently good or bad for the global economy.
Right, absolutely not.
As analysts, our job is to impartially observe the mechanics of the policy and how it impacts the balance sheet of the company we are evaluating.
Understood. And the mechanics of the situation are actually pretty straightforward.
Right.
First, Solar is waiting for absolute clarity from the Commerce Department.
Okay.
If the U.S. government drops the hammer and implements severe Section 232 tariffs on these foreign components, the price of imported panels will instantly skyrocket.
Because they'll be heavily taxed.
Exactly. Chinese-backed competitors will be effectively locked out or priced out of the U.S. market.
So what happens to First Solar in that scenario?
If that happens, First Solar's options contract pays off. They instantly ramp their Malaysia and Vietnam factories up to 100% capacity.
Right.
Because First Solar's specific thin film technology might be exempt from tariffs targeting polysilicon. They can import their own finished products from Asia into a highly protected, artificially inflated U.S. market.
Wow.
And they would capture massive profit margins.
Oh, wow. So if the tariff comes down hard, the domestic price of solar panels spikes because supply dries up. Suddenly, First Solar, sitting on all this idle capacity in Southeast Asia, flips the switch, floods the U.S. market with your own proprietary panels, and cashes in on the price surge.
Exactly. It's brilliant.
Yeah.
But let's look at the alternative scenario.
Okay.
If they were to ramp up production to 100% right now, before the tariff decision is made, they would just be dumping their own panels into a global market that is already massively oversupplied by cheap Chinese hardware.
They'd be competing against sub-10-cent panels.
Exactly. They would be forced to sell those panels at a severe loss. And Section 232 isn't the only trapdoor they are navigating. The regulatory minefield is incredibly complex.
Right.
There are also Section 301 tariffs, which deal with technology transfer and intellectual property theft. There is the ongoing AD/CVD investigation.
I am glad you brought up AD/CVD. That stands for anti-dumping and countervailing duties.
Right.
If I understand the mechanics correctly, anti-dumping is when the Commerce Department determines that a foreign entity is deliberately selling a product in the U.S. below the actual cost it takes to manufacture it.
Yes.
Simply to bankrupt American competitors and capture market share.
That's exactly it.
And countervailing duties are applied when a foreign government provides illegal state subsidies like free land or 0% loans to their domestic factories, giving them an unfair advantage on the global market.
That is a perfect summary. And the U.S. International Trade Commission and the Commerce Department are currently investigating whether solar companies operating in Southeast Asia are guilty of these practices.
Got it.
If they are found guilty, the U.S. can apply massive retroactive tariffs to their products.
But here's where the options contract strategy becomes risky, right?
How so?
What if the U.S. government caves to pressure? Because utility companies in the U.S. desperately want cheap solar panels to meet their green energy targets.
True.
What if the administration says, yes, dumping is occurring, but we are going to grant sweeping waivers and exemptions to certain countries because we simply need the hardware too badly?
Well, that is the nightmare scenario for First Solar. If the government grants waivers or implements toothless quotas, it completely dilutes the protective power of the tariff.
Right.
It would allow foreign competitors to continue sneaking artificially cheap panels into the U.S., which would instantly undermine First Solar's domestic pricing power.
Wow.
And that is the exact reason management is holding their production capacity hostage. They are engaging in a multi-billion-dollar geopolitical staring contest with Washington, D.C.
A staring contest, yeah.
They will not commit capital to full production until the ink is dry and the regulatory environment is set in stone.
It is a remarkable display of patience. Sitting on your hands while absorbing a $120 million annualized loss requires a profound belief in your long-term macro thesis.
It really does.
Which brings us logically to our final analysis. We've explored the complex accounting, the physical realities of the supply chain, the intricacies of advanced copper replacement technology, and a labyrinth of international trade law.
We've covered a lot of ground.
We have. So let's distill this into actionable intelligence. Give it to us straight. If you are an investor looking at First Solar right now, is this earnings call a fundamentally bullish or bearish signal?
If we synthesize the totality of the data, the strength of the balance sheet, the backlog, the technological roadmap, and the strategic positioning, this is an overwhelmingly fundamentally bullish signal.
Okay, bullish.
However, it is imperative that investors understand this bullish thesis comes attached with a massive policy asterisk.
Let's break down the bull case first. Why are you confident in the core business?
The primary reason is unparalleled revenue visibility.
Right, that backlog.
Yes. Their domestic manufacturing fleet is essentially sold out through the end of 2028. There is almost no other heavy industrial manufacturer in the world that knows exactly how much revenue is guaranteed to walk through the door 4 years from now.
It's unheard of.
Furthermore, their balance sheet is a fortress. They are sitting on $1.7 billion in net cash.
Wow.
In an environment where interest rates are high and capital is expensive, having a massive cash pile allows them to weather unforeseen logistical storms. They can self-fund their factory expansions without taking on toxic debt, or aggressively pursue mergers and acquisitions if smaller competitors go bankrupt.
And beyond the balance sheet, the macro demand driver is completely decoupled from traditional economic cycles.
Exactly.
The hyperscalers, Google, Amazon, Microsoft, are engaged in an existential race to achieve artificial general intelligence. They view AI infrastructure not as an operational expense, but as a survival imperative.
In an arms race.
As we discussed with the Cypress Creek project, their demand for 247 baseload renewable energy is insatiable, and critically, it is price insensitive.
Completely price insensitive.
Google does not care about a 5-cent premium on a solar panel when they are spending billions on NVIDIA GPUs. First Solar provides the only guaranteed, politically de-risked energy solution for that specific infrastructure.
Exactly. They are the ultimate, safe, reliable, U.S.-backed bet in a highly volatile global market.
Right.
But we must address the policy asterisk.
Yeah.
What is the fundamental risk to this thesis?
The primary risk is policy dilution. First Solar's incredible 57% gross margin is currently heavily subsidized by the U.S. taxpayer via the Section 45X manufacturing credits.
Yep.
And their domestic pricing moat is protected by the threat of trade tariffs. If the political winds in Washington, D.C. shift, regardless of which party is in power, that moat could evaporate. If a new administration decides that rapid decarbonization is more important than domestic manufacturing, they could grant wide-sweeping waivers on the Section 232 tariffs or AD/CVD penalties to appease the utility companies.
Right, which utility companies are lobbying hard for.
Exactly. If the U.S. market is suddenly flooded with 10-cent Chinese panels, First Solar's competitive advantage would be severely blunted. The stock is inherently, inextricably tied to the protectionist mood of the federal government.
It is the defining risk. Investing in First Solar is not just a bet on solar technology. It is a bet on the continuation of U.S. industrial policy.
So here is our final actionable advice for you today. If you hold First Solar in your portfolio or you are considering initiating a position, you need to understand exactly what you own.
Right.
You are not just holding a standard generic green energy stock. You are holding a highly specific, dual leveraged position on two of the most powerful macroeconomic trends of the decade.
Perfectly said.
First, you are betting on the U.S. reindustrialization and trade protectionism supercycle. You are betting that the U.S. will continue to mandate and subsidize made in America critical infrastructure.
And second,
you are betting on the AI data center energy boom. You are betting that the computational power required to train future AI models will continue to demand massive new grid-scale power generation.
Spot on.
As long as America wants to build its own physical hardware and Silicon Valley wants to build bigger, more power-hungry digital brains, First Solar is sitting at the absolute dead center of that Venn diagram.
It is a remarkable convergence. We're witnessing the intersection of cutting-edge software development and heavy industrial manufacturing, all mediated by international trade law.
It's wild.
And based on this call, management seems acutely aware of how unique their positioning is, and they are playing the long game accordingly.
Let's wrap this up and summarize the vital takeaways from our deep dive today. First, the core demand is ironclad. First, solar possesses a massive $13.6 billion contracted backlog stretching into 2030, fueled directly by the unyielding energy requirements of data centers and hyperscalers.
Second, their operational profitability is at record highs. We saw a massive EBITDA beat this quarter, driven by a 57% gross margin that is heavily padded by government tax credits and tariff-related benefits.
Third, we have to recognize the very real friction in the physical world. They are facing severe temporary margin pressures from domestic logistics, highlighted by the absurd reality that trucking a panel across the Midwest costs as much as shipping it across the Pacific Ocean.
And finally, management is operating with extreme strategic discipline.
They really are.
They're willing to delay domestic factories to implement superior cure technology, and they're maintaining an expensive, highly calculated holding pattern in Southeast Asia, waiting for final clarity on U.S. trade policy before deploying their full capacity.
That perfectly encapsulates the narrative of this quarter. It is the story of a company operating from a position of immense financial and technological strength, yet constantly constrained by the physical realities of domestic supply chains and the unpredictable shifting sands of government policy.
Which brings us back to where we started this conversation.
Right.
When you read a headline that says, First Solar revenue drops 4%, the natural instinct is to panic. But as we've uncovered today, modern investing requires you to look past the surface.
You have to.
You have to understand that a drop in revenue might actually mean a healthier pipeline with fewer cancellations. You have to understand how government subsidies, battery chemistry, and international tariffs interact to create a 57% profit margin.
You have to know the why behind the numbers. The surface data is meaningless without the underlying mechanical and political context.
Exactly.
And that leaves us with one final provocative thought for you to mull over as we close out this analysis.
Okay, lay it on us.
We have spent a significant amount of time exploring the AI industry's insatiable, exponential hunger for electrical power. And we have thoroughly discussed how domestic trade policies are aggressively attempting to choke off the supply of cheap foreign solar panels in order to force the creation of a resilient U.S. supply chain.
Right.
But what happens if those two massive, unstoppable forces collide head-on?
Oh, man.
If the power demands of artificial intelligence continue to double every few years, and U.S. protectionism successfully locks out all foreign solar imports, what happens when the energy demands of the tech giants simply outpace the physical capacity of domestic manufacturers like First Solar to actually build the panels?
That is the question, isn't it?
Could the availability of a simple, heavy piece of architectural glass and cadmium telluride actually become the physical, real-world bottleneck that limits the future of artificial intelligence?
It is a fascinating paradox. We spend all our time worrying about software limitations and semiconductor chip shortages, but ultimately we might find that the true limit to artificial general intelligence isn't the brilliance of the computer code. It is the physical capacity of our construction industry and the logistical limits of an 18-wheeler driving across Ohio.
The digital revolution, entirely dependent on heavy industry. Something to think about the next time you ask an AI a question. Thank you for joining us on this deep dive.